And welcome back to another edition of Road to Achieving Financial Independence. My name is Mike Riskin, president of CPS Investment Advisors. And always, I'm joined by my partner, Pete Galacco, CEO of CPS Investment Advisors. How you doing, Pete?
I'm doing great, Mike. How you doing?
Terrific. Thank you very much. We have some current event podcasts today.
Yes, we do.
Some breaking news, so to speak. And
Boy, it's an interesting world, isn't it?
A lot going on.
There's a lot going on.
And our audience may notice there's a third person with us today. And let me introduce him. He's one of our podcast producer extraordinaires. And he also is a licensed mortgage broker.
He moonlights doing mortgages.
That's right.
Podcast full time.
He's our podcast producer. That's right.
It feels kind of weird being on this side of the aisle. I feel smarter already.
That's right. He goes by the name of Captain Mortgage, but he is our producer, Jared Slater. So welcome, Jared, to the show.
It's good to be here, man. Let's talk interest rates.
That's right. And so we are going to talk interest rates today. And as I mentioned, the Fed recently did cut the Fed fund rate by 0.25%. So no real surprise there in terms of expectations. I know some people were maybe hoping for a 0.5 point. Some people thought maybe there'd be no cut, but the direction seemed to be 0.25 point, and that's where we're at. So Pete, I'd like to kick off the podcast by really helping our audience understand what the Fed cut 0.25%. What does that mean?
What does that mean?
What's the significance of it, and kind of what's this thing I keep hearing about, a Fed mandate, and so help our audience understand that a little bit.
So first of all, the Fed cut didn't come at a surprise.
Right.
All right. I believe the market already had that built in, and honestly, I think the Fed should have cut it maybe earlier in the year when the markets were a little rocky. Let it kind of absorb into the economy. But they usually wait too long. They usually overdo on one side, overdo on the other side. So this is going to be interesting to see what happens. I think at 0.25 point, those looking for 0.5 point, I don't see that happening.
Yeah.
I think if we got a 0.5 point, that would have told us that we have a real problem in our market,
right,
in our economy.
I agree.
Yep.
Yeah, because that's one thing the Fed has is the ability to help our economy by lowering interest rates and speeding up the economy. Right now, as we're coming off of high inflation, one thing we don't want to do is bring inflation back, okay? So 0.25 point was a pretty good rate cut, all right? They're predicting a few more by the end of the year. I kind of doubt that's going to happen.
Yeah, it'll be interesting to see.
Yeah, because we got to give this a little bit of time.
Right.
If you jump in and lower it too much, then you're going to cause another problem.
Right.
So I wasn't excited to hear that they had this on the table that we're going to raise it more, but usually they do that and they don't raise it. And we've heard that from time to time. We're going to raise it, we're going to lower it, and they just don't do it. So they're looking to lower it again. I think we probably see another lowering probably early first quarter next year.
Okay.
And that'll give us a good idea where the economy's going. But this 0.25 point, what is it going to do to you as a consumer? Well, first of all, if you have a variable credit card rate, they're going to come down a little bit, so you're going to pay a little less interest on that. But a lot of credit cards aren't variable;
right,
they're fixed.
Right.
Okay, so a few people are going to get a bonus there. Your auto loans and personal loans should come down a little bit,
right?
And everybody suspects the mortgage rates are going to come down.
Aha!
That's our guess.
That's
right. But we all know that mortgage rates do what they want to do.
Yes, they do.
But really, the big catalyst of this is to lower the borrowing amount for corporations.
Okay.
So that they can, in turn, take the extra money that they'll be saving and hire more people to produce more goods.
So help stimulate the economy a little bit.
So it's a short term.
It's a short term stimulant.
Okay.
Correct. So if we get more employment out of that, of course, more employment means more velocity money through the economy,
right,
people buying more goods have to be produced, wages go up. It's a really good thing.
Right.
All right. And when you raise interest rates, it stifles all of that. It really does.
Yeah.
And raising the interest rates over the past 5 years, had to happen because our inflation was way out of whack.
Right. It's definitely one of the main lever the Fed has in, none of us wanted that 9-10% inflation number. And so the Fed almost had to raise rates. I think one of the two mandates of being full employment and price stability. Mm-hmm. And certainly when they look at that price stability, they had to raise the rates.
So there's a lot of money on the streets for the government. And that caused our economy to heat up to a point where now we're paying exorbitant amounts. And I hear a lot of times people say, well, inflation's only at 2. Why isn't prices coming down?
Right.
Well,
It's
that's,
still a 2.
yeah, it's not, doesn't work that way.
Yeah.
Inflation compounds.
Mhm.
If you got 5% inflation this year and 5% inflation next year, it's a total of 10% inflation.
Right.
Now, if you get 2% the year after, that's 12% inflation.
Right.
It doesn't go the other way.
It's a year-over-year number, not
Yeah,
you're not
correct.
starting from the same starting point.
Right.
That's correct. But there are some costs that you can expect to go down. I expect gas prices and fuel prices to continue to slide a little bit, which should help everything long term.
Yep.
Okay, because everything touches oil. But having interest rates come down is going to make people a little bit more excited about what's going on. If we see mortgage rates falling, hopefully that'll happen. We're going to see more people excited about
Yep.
either buying homes, building homes, or refinancing homes, and that's
Right.
why we got
That's right.
Jared
We'll get to that in a minute.
Right.
That'll be a good conversation for sure.
But even if we get another quarter point this year, I don't think it's going to have a drastic effect on what's going on.
Right.
In
In terms of the economy.
correct,
Yeah.
in terms of the economy, and I still think interest rates, mortgage rates are still going to be around anywhere between 4.5 and 6. I think that's where they're gonna fall into, because normally they're higher a little bit. That's a normal interest
Yeah.
rate. We saw an anomaly for a long period of time where interest rates were real low.
Yeah.
That's not going to happen again, hopefully.
Right.
So
And let's face it, that low of interest rate is really not a good thing.
No.
It's good if you're buying a house and
It
that's
is.
or
It's good for
borrowing
the
money.
consumer.
It's great
Yep.
if you're borrowing money, but it's really a sign. The only reason the Fed would do that, and also maybe the rates would come down that low, would be that sentiment is so horrible.
Yep.
That they really needed to stimulate the economy in a major way, which is what had happened.
And we saw that in 2008. They had to do something
Right.
because people were losing their homes.
Right.
They're losing their retirement. Things were really bad. So to bring the interest rates down to help spark the economy, that was the right thing to do. I think they just kept it down a little bit too long.
Yeah.
But again, every time they went to raise it, the Fed would say we're possibly going to raise it. Something else popped up in our economy that made them take a step back and a breather.
Right.
So I don't know if that was the right thing to do, but a lot of us were able to buy homes or refinance our homes for a long period of time at a very low interest rate.
Right.
So those that are able to do that got a huge benefit from
That's right.
this.
Yeah.
Right.
And before we jump into that, one other thing about the Fed fund rate in terms of who it may affect, it will affect, and it's a quarter point, so it's not dramatic, but it will affect some of our savers.
Yep.
It'll probably lower your potential CD rates.
Yes.
It's going to lower your money market rates. So for those of you that own those types of investments, you might see a tick down in your rate that you're getting.
Money market rates were 4.5 for quite a while.
They're probably going to drop below 4, I would think, at
I
this
would
point.
think so. And every time you get a lower end, that's going to drop also.
Mhm.
So you're going to make a little less money if you're on the interest side of the balance sheet.
Right. All right. Well, enough for the boring talk and the Fed
yeah.
talk. We could, I guess we could geek out a bit about it all day, but we've got the captain here, Jared Slater.
Let's do it.
And Jared, give us a sense of what you're seeing. So like I said, Jared, well in tune with the mortgage industry, the new home purchases and the refis. Kind of give us a general sense.
Well, I'm
of
glad
what's
we
going on.
started off by really breaking down what the Fed rate actually is, because there's a huge myth in our industry, and a lot of it is media driven, that when the Fed says they're going to cut rates, they're literally going to cut interest rates on mortgages, which, as we just discussed, that's not the case. There's a lot of factors that go into what sets the interest rate, because it's more of a long-term thing. Mortgage-backed securities, the 10-year yield comes into play.
So I think the 10-year yield is right.
Yeah, so that's that's the big driver of interest rates for mortgages. This time last year, when they cut, believe it or not, mortgages became the worst they had been in 3 years. So it had the opposite effect. And so what's going to happen this time around, who knows? But a lot of the factors are the stability of the labor market, inflation, which we've talked about. So those are more going to drive what happens with interest rates. But what's most important is are homes affordable? And I think that's more where my clients, they need to be focused on. So as far as what's going on in the industry at this snapshot in time, believe it or not, refinances are up. They're up by 60% in the last couple of years. In fact, I'm sitting on more refinance loans at the present time than I am purchases. So they are making a comeback. Are they large numbers? Are they a big market share right now? No, but they are increasing. So
now,
it is.
Out of curiosity, are these folks that got in maybe at an adjustable rate? a couple of years ago when rates skyrocket, or actually
These
fixed
are
rate probably,
these
right?
are
A
your
couple years ago?
2023 and to present day borrowers.
Okay.
A lot of them, and a lot of them,
So
to
when
be
rates
honest,
shot up and they got
are within, for me, in the last 18 months.
Okay.
You know, they are. So those are kind of the folks that are kind of resetting their sheets. Now, there's a couple of different reasons why. It's not just the interest rates that some of these borrowers are choosing to refinance. Some of them have maxed out their debt.
Oh.
So when you do your blended rate, when you take all of your debt, you know, car payments, you look at credit card debt along with your house, and it makes more sense to take cash out of that equity and pay off some of that other debt and take the higher mortgage rate,
Right.
because
It's spread over a long
it's spread over a long
period
period of time. So a lot of folks are doing that,
But
which
do
kind of
it
goes back to
unless you can't discipline yourself and you get back right back in the situation. I see it happen a lot.
and that's
You
the,
refinance your home, you pull the equity out, you pay off all your debt, and all of a sudden now
you do it
there's
again.
debt again.
That's right.
Right. Yeah.
And that's the worst.
And you're in a
thing.
worse
Worse
situation you were
situation.
before.
I think the cure for that is to go back and I think we have a podcast on that actually. So
We do.
Yeah. So, yeah, I mean, so overall, like, I think people have kind of absorbed where interest rates are going to kind of land, and you just discussed it between 4 and 6. I think the longer we've gone on, people are accepting that now. Finally, because before everybody was just kind of holding out for that. Well, I'm waiting for that 3% again. I mean, I agree with you. Those are gone.
When I bought my first house, 7% was a score.
Oh yeah.
It was
Yeah.
a score.
Well,
I
and
got
I
the
think-
lowest interest rate at 7. I couldn't believe
I
it.
think 7 historically is the average.
Yep,
I think
right.
if you average it all out over the last 50 years, 7% is kind of
right.
the norm. So, I mean, I think we're in a pretty good spot. I mean, I'm doing a lot in the 5%, and, you know, disclaimer, there's a lot of factors going into interest rates, credit, you know, income. So I don't want to think that everybody can just get a 5% rate, but those are, I'm starting to see those rate sheets more and more, which is a good sign. Now let's go to the flip side of that. The lower the rates, the more the borrowers come into the market. Now, if you remember in 2022, we had it was a strictly a seller's market. We had multiple bids on homes, and it was driving appreciation up, which was making the affordability a problem.
Right. Yeah.
So, you know, it's kind of a, you know, be careful what you wish for, because if the rates come down too low, you'll get an
Prices are
influx
gonna
of
go
those
up. Right.
borrowers, and then the home prices go up. And so all you did is trade an interest rate for a higher price home, and it's at the same situation. So you got to kind of thread the needle. I mean, the best thing that you can do, and I tell this to my borrowers all the time, especially the first-time home buyers, you have to focus on your why first. Why are you buying a home? Is it because this is an investment opportunity? Is it because it's a family situation? Are you downgrading? Are you upsizing? Are you getting out of a situation? And you really have to dial in what is that driving force. And if you can identify that, it's going to do two things. It's going to set you on the right path and in the right program and the right product, but it's also going to keep your head in the game. Like, mortgages are a roller coaster. Getting a loan is not for the faint of heart. And so if you understand why you're doing it, you're going to kind of stick with it and kind of get to the finish line.
Yeah, it's a great tie into what we do at CPS in terms of financial planning, and we've talked about this a million times. Making those poor decisions, and a lot of times it does start with the home purchase.
It does.
Look, you know, we all want a nice home. We all want something for our family. Sometimes we get spousal pressure, whatever it is, friend pressure,
Right.
and we bite off more than we can chew. And then next thing you know, you can't really afford to live, or you try to live, and then you end up in that credit card debt situation. You really, really need to be mindful of how you're entering the housing market.
Yeah, don't
that's kinda rolling the
don't
dice.
ever buy a house with the assumption that you're going to be able to lower the rates to make
Right.
make it affordable. It's got to be affordable where you enter. If it's not affordable where you enter, you're going to put your financial well-being at
Right.
risk.
Yeah, because you could be there for a while.
Could be there for a while. And you don't know, if you buy more house than you need, you don't know if your debt's going to go up. If your debt's going to go up, your credit may get bad. Then all of a sudden you can't refinance and you're stuck.
Or you switch careers. I mean, that's a big one with a lot of clients is, the regulations and the oversight in getting a loan are so severe now after 2008 that, you may change jobs, and that may jeopardize your ability to get a loan, which may hinder your ability to make a lateral move
Or
or
lose your job.
downside, or
Yep.
you lose your job. So yeah, to your point, yeah, absolutely. There's a lot of unknowns.
There's something that we used to do a long time ago that they don't do anymore. It's called putting 20% down on your house.
Oh yeah, those days are gone.
Oh, really?
Those
Those
days
days
are.
are gone.
Man, I still live by
Oh
that
man,
rule.
I still live by that rule too.
I can't remember. Well, yeah, I can't remember the last time. I can't remember. There's very few times I think I've done a 20% down
And a
mortgage.
lot of times,
Really?
more times they're
Yeah.
asking for their closing costs to be paid for because they don't have the cash
They
for
are.
that either. So, I
So
mean,
really, they're coming. I mean, is that what we're seeing, Jared? Is people coming in just basically almost near 98%?
Yeah, I
loan
think
to
I
value?
mean you
Wow.
can first-time home buyers can 97% loan to value.
97.
You know, FHA is 3.5% down is the only requirement. Even on refinances, 5% on a conventional loan, so that's very
Okay.
common.
Okay.
So I mean, to your
that
point,
makes
yeah,
me
it's
nervous.
yeah.
That makes me a lot nervous.
Well, I mean, it's yeah. I mean, you're kind of rolling the dice. I mean, it's you look at what got us into this conundrum in the first place.
You're absolutely right. And with the prices of housing the way it is, and if we ever do go into recession, even small recession, we can see those housing prices go down.
down
All of
even
a sudden,
further,
you're underwater.
Yeah. Well, and you get to peel back the curtain when you're looking at different portfolios and qualifying folks for mortgages. You get to see what's important and how they spend their money.
Right.
And I could tell you the debt issue is real in this country. There is a significant amount of debt. People are living via credit cards, and it's a little unnerving to kind of see that. So some things do have to change. I think these discussions are healthy because I think there's a lot of folks that just don't have the discipline or the education on how finances work.
Yep.
Right.
Yep.
Right. And some of the I know I've been out with you before, and you have a loan deal going on, and the person's you've got them all qualified and balance sheet looks good, and they call you up and say, hey Jared, come check out this new truck I just bought.
Just happened to me last month.
no!
Talk to some of our probably maybe not just our younger folks, but talk to some of our clients out there, our viewers, about maybe as you're going through the loan process, some of the the don'ts.
I call it the transaction triangle. So in order to qualify for a mortgage, you have to think of it in three pillars. Okay, so I call it the triangle because everybody likes shapes and I like pictures. So if you picture it, at the top of the triangle is credit. Credit drives everything. It all starts with credit. It all ends with credit. Credit sets the interest rate. That kind of gets you into the door and what program you're looking for. The second one is going to be your debt to income ratio. How much money do you bring in versus how much do you spend?
Right.
And the third one is down payment. So these days, the down payment tends to be the lesser of the three.
That's what
But I tell people 2 out of the 3 have to be on point. You can miss on 1, but you cannot miss on 2. So if you've got 2 of those 3 that are in pretty good shape, you're going to be lendable. You just are. But to your point, just happened to me last month. We were at the finish line to close a deal, and they decided that a Corvette looked really attractive and very good.
I mean, it's hard to argue about a Corvette,
Right?
Yeah, I agree with that.
So-
But the
They're
money,
begging the guy to buy it, I'm sure.
Needless to say, they're driving around in a Corvette, and they are not
Right.
living in the house.
There you go.
Oh, no.
So it's
There you
just
go.
so you got to be disciplined. Especially these days with all the technology and the AI, everybody thinks that you can game the system. You cannot. It's like these lenders, they spend an obscene amount of money making sure that everything that you give them is valid, it is real. You cannot manufacture this stuff. They're going to find out.
So we did learn a little bit from the 08-09 crisis then.
Absolutely.
little bit,
yeah,
yes.
A little bit.
100%. Yeah,
Because that was a big piece of the
we're still
Yeah.
doing some bad
It
things.
sounds like we're still doing some bad things.
Yeah. So, I mean, I think overall the real estate market in general, I mean, and again, I don't want to predict the future, but I think the 08 crisis I don't think it's repeatable just because of the way the regulation is. Sometimes I think certain areas are overregulated, if that could be a thing, but I think it's pretty safe in that regard.
And for the listeners that don't remember what happened in '08, we had a financial and a real estate crisis. And what was happening where people are getting these loans with no income, no documentation.
Right.
They're buying 4 or 5 houses and flipping them at the table. It was very easy to make money buying real estate until it wasn't,
Right.
until it all fell apart. And there were a lot of people held holding the bag. And it got really bad for a lot of people.
Right.
So what we learned was buy what you can afford. Don't buy any more than that because you may end up in that situation. And don't use real estate as an investment that's supposed to grow like that, because normally real estate doesn't grow more than 2 or 3% a year.
Right.
But when it's growing 18, 20, 30%,
Right. Everyone wants to get
that's when you got to be careful.
Yeah.
So we learned a lot there, but the mortgages are so easy to get. And I can see now, people are having trouble getting mortgages. I can see that they kind of locked that up a little
Yeah.
bit.
So at least, there's two issues, right? In 08, 09, it certainly was about it wasn't fraud, but it was just lending money without doing your due diligence.
Yep.
At least now, as financial planners, there might be some things I think we don't agree with how much they're lending to certain people, but at least there's some level of a balance sheet that they're
Correct.
lending
Right.
against.
Right.
Yes.
So that it's not just a empty sheet of paper.
Yeah,
So
I agree.
I think there's some
Well, and as technology keeps going, not to keep coming back to the AI piece, though, I think that's going to have a big play in the industry in the next couple of years, and especially on the underwriting part of all of this.
Oh, okay.
No, I really do. It's going to streamline the process. In some ways, it's going to make it more difficult. In some ways, it's going to make it easier. So, but I think the human part is still going to be essential, and you still have to have the face, and even more so when we live in a digital world, it becomes even more refreshing when you have kind of that human interaction. And I think that goes back to what CPS has done well. I've sat behind the other side of the table on many of these podcasts, and I think that's just a testament to how you guys do things. You go back to the human part first. You find the why. And then you ultimately can drive the force to get to the end game.
Well said, Jared. I appreciate that. And
Yeah, I do appreciate that.
well, folks, it was all things interest rates today. I think certainly the Fed fund rate cut was the headline maker, 0.25%. But I think we wanted to have Jared on here today to help, because I think people just assumed the correlation. So we wanted to give some education into what the Fed fund rate cut really did mean, and also how does it affect or does not affect mortgage rates, and get a little discussion going on the housing market and the interest rates there. So appreciate you joining us.
Absolutely.
The face
Great
behind the camera.
information. Yes.
And everyone always tells me and Pete we have faces for radio. So
And voices for
and
newspaper.
voices for newspaper. That's right. Thanks for joining us, and we'll catch you on the next one. And tune into our YouTube channel or anywhere else where you get your podcast for other additional educational content. We've got a lot of things rolling out here in 2025. Thanks again for watching. And if you'd like to contact us, feel free at info@cpsinvest.com, as well as 863-688-1725. And look forward to doing this again soon. Thanks again. Bye.